All right. Good evening, everybody. We are live on Facebook for this week's podcast. So, welcome to another edition of Wealthy and Wise Wednesdays, where I share a few words of financial wisdom to help put you back in the driver's seat of your financial future. Today is Wednesday, May 26th. Thanks for joining me this evening. I think that this week's discussion will probably be a little bit on the shorter side, but will be very, very impactful. I raised some eyebrows this morning with a post that I made on Facebook, and so I wanted to talk about it a little bit more in depth here this evening for Wealthy and Wise Wednesdays. And what I did was I shared a graphic that showed that bond interest rates are back on their way down. And so I posed a question just saying, hey, if you really think that inflation is going to be running rampant, and if you could lock in a 30-year mortgage at 2.5%, wouldn't you do it? Wouldn't you be a fool not to? And here's some of the reasoning that I give. And again, the reason that I'm bringing this up, and this, like everything else, this is not to be taken as specific or personalized financial advice, right? This is education and to apply it to your specific scenario. But the reason I bring that up is because the financial industry has told us over and over again that all debt is bad. You should have a 15-year mortgage, and you should try to pay off that mortgage as soon as possible. And if you have a 15-year mortgage, and if you can handle that payment, and you are also able to save and invest outside of your mortgage payment, great, okay. Maybe I'm not speaking to you. I think that you would benefit by, again, depending on how old you are and your time horizon, I think that you would greatly benefit by being in a 30-year mortgage, but I don't want that to sound condescending. I'm really good at the shock and awe posts to try to grab people's attention, but I also know as a 240-pound bald-headed guy with a goatee, I know that I can sometimes be a little intimidating or come across in ways that people think I'm just trying to pick on them or insult them. And I'm not. I put stuff out there, and I do it in a way that I'm just trying to get people to just wake up and just take a look at the post and just read it and consider it, right? But again, going back to it, if interest rates are on the way down, and I just did a Wealthy and Wise Wednesday reporting that on this last 12-month cycle ending in April, that inflation was the highest it's been in a decade. It went up 4%. So inflation's over 4%. So if you could take hundreds of thousands of dollars on your mortgage and lock it in at 2.5%, let's say, wouldn't that be the smart thing to do? Here's a couple of reasons why I say that. Number one, at 2.5%, you are literally borrowing money for less than the pace of inflation. You're basically borrowing that money for free. And if inflation's at 4 and you're borrowing at 2.5, it's almost like the financial matrix is actually paying you to borrow money. Why wouldn't you do it? Reason number two, we know that the Federal Reserve is printing money like crazy and devaluing the currency, taking the value out of the dollar. Look, I am deeply distressed at what the Federal Reserve does. I'm disgusted with it. But I think that the best way to stick it to them is to turn it around on them and use what they're giving us to our advantage and not their advantage. Because if they're going to devalue the dollars, and look at how much they're going into debt. Why do they go into debt? Well, their debt is a certain number, but they want to pay it back way later. They want to pay it back with a dollar that's devalued, but the actual number is the same. So if you're locking in a 30-year mortgage at 2.5%, the money that you're paying back 10 years from now, it's going to be the same number, but the value of those dollars is going to be much less. The number that you're paying back 20 years from now, again, because it's a fixed rate mortgage, the number is going to be the same, but the actual value coming out of your pocket is going to be much less. And especially 25 years down the road and 30 years down the road, the dollars that you're paying back, again, it's a fixed dollar amount, but the actual value that you're parting ways with, it's going to be much less. And again, so that's taking the Federal Reserve's game, turning it around on them and using it to your advantage. So again, we just simply have the fact that interest rates are lower than the pace of inflation. And then why rush to pay these dollars back? Stretch it out over a long time. Pay them back with devalued dollars. After all, they are the ones, through their monetary policy, through all of their printing, they're the ones devaluing the dollar. So turn it back around on them and pay them back with their own devalued dollar. Next up, I said that the mortgage interest that you pay is tax deductible. And that's true, but I had a couple like really aware posters or commenters say, hey, yeah, that's true, but you're probably never going to do that, at least under current tax law, because under current tax law, the standard deduction is so large that most people probably aren't going to be itemizing. And that's a really good point. So my counterpoint to that would be, and that's great input. The counterpoint to that would be they could always change tax law again to where having the mortgage interest being deductible, where that might make sense and it might help you. Here's the other thing. Now let's talk about your monthly budget and your financial picture. Number one, by having a smaller payment, you are increasing your cash flow and you're lowering your risk. So you're able to grow and maintain higher liquidity reserves, both to handle emergencies and to take on opportunities. And if you have more liquidity to handle emergencies, that means you do not have to rack up bad debt on a credit card at 15% or 20% interest. You can have the liquidity to tackle those emergencies with no problem. And your investments over time, look, if you're locked in at 2.5, 2.75, 3% on a 30-year mortgage, your investments over time should do much, much better than that, right? Now, look, I know the stock market has been very volatile lately. I know that cryptocurrency has been very volatile lately, but I'm talking about over the course of many years in the long run. Your investments should much outpace that 2.5% you're borrowing money at. And then finally, even your safe money strategies where you're just trying to save money, even those are going to be growing at a rate that's higher than your 2.5% mortgage. You could put money into a whole life contract, gaining 4%, 4.5% completely tax-free, where you maintain complete control, liquidity, and utilization of that money while you build your equity. Now, I'm a huge fan and a huge believer in whole life insurance for all of those reasons. But when you're just really looking at it, hey, whole life is a bond substitute that I'm holding in my portfolio, and it's giving me much more benefit than the 2.5% mortgage that I've got. Again, this is my opinion. This is education. This is not financial advice, but these are all really, really good reasons why you should consider doing a 30-year mortgage and locking in low interest rates. Here's another thing that people just don't consider. Again, my tagline is the financial matrix in the financial planning community, Wall Street, the Federal Reserve, the Internal Revenue Service. What they do is they create false narratives. They spin these narratives and they play it off to you as if it's financial education, as if they are looking out for your best interest. But here's the thing, they're not. They're programming you to influence the way that you think in order to get you to act in a way that's going to profit them much more than it's going to benefit you. Why is it that the banks offer slightly lower interest rates on 15-year mortgage loans? Is it because they just want to be nice? Is it because there's actually less risk on a 15-year loan? I don't think so. How do we do our budgets? Do we do our budgets over the course of 15-year periods versus 30-year periods? No, we run our budgets on a monthly basis. And on a 15-year note, that monthly payment is higher. And so you are more at risk to being able to not make that payment. Do you know why the banks incentivize you on a 15-year note with a slightly lower interest rate? Because that payment is higher, which means it's going to provide them with more cash flow, which is going to put them in a more secure position. And when they get more cash flow on their books from your 15-year higher payment, they're able to turn around and relend that money back out, of course, times 10 because of the fractional reserve banking system. But they've got you tricked into saying, oh, I'm getting a little bit less of an interest rate. They want you to have that higher payment back to them. They don't necessarily make all of their money off sheer interest alone. They make their money off of the spread. They make their money off of the velocity of money. They have a bigger payment coming in, which goes onto their books, and they're able to relend that money out 10 times higher because of the fractional reserve banking system. And here's the other thing. At 2.5% interest, people think, oh, that's not much interest. The bank's not really making much. The banks aren't making their money on the sheer rate, the sheer amount of interest. They're making their money on the spread, because even if they're charging somebody 2.5% interest on a 30-year mortgage loan, what are they giving you on your savings? Not very much, are they? You have to remember, when you put your money with the bank, your money is in a lended position. You are lending your money to the bank, and they are paying you an interest to borrow your money. You got to remember that. They're not just giving you interest because they're nice. They want your money. That's how they incentivize it. So your money that you deposit with the bank, it's in a lended position. And if the bank, if they're paying you, let's say 0.5% on your savings accounts, your CDs, your money markets, that's a big if. If they're paying you 0.5% and then they're able to go and lend that money back out at 2.5%, you may think to yourself, well, they're only making 2%, 0.5% up to 2.5%, but that's not the right way to look at it. When they're giving you 0.5% on your savings and they turn around and they lend that money back out at 2.5%, that's 5 times as much. 5 times as much. That's a 500% return on the spread. That is how banks make their money. And that's why they're enticing you on that 15-year mortgage loan. Oh, we'll give you a little bit lower interest rate because your payment's going to be a lot higher, which is good for their balance sheet, which is good for them to relend that velocity of money. They're making money. You're not, because if your payment's higher, again, you have less cash flow every month. That means you can save less and invest less. And here's the other thing. I understand that, like, somebody going into retirement, they may feel a good sense of security to not have a mortgage payment. And I get that. But here's the thing to consider, and a lot of people don't. If you, whether you have a 15-year loan or a 30-year loan or anywhere in between, if you are aggressively overpaying because you're prepaying your balance, trying to get that balance down, you're putting yourself at incredible risk, because you're locking up your money in the walls of your house. And you cannot always, it's not guaranteed that you can access the money that you've locked up in equity. Sometimes mortgage equity is dead equity. Consider this. Let's say if you have a 15-year loan and you're overpaying it and you're getting really aggressive with it, you're paying the balance down, you could be 2 years away from having your house paid off. You could have maybe only $30,000 left on the balance. But if anything bad happens to you and your family, a death, a disability, a job loss, an illness, and if you miss a few payments, guess what? All of that extra money that you paid, it doesn't matter. They don't take that extra money and apply it to your next payment. Your house could end up going into foreclosure. And what that means is not only did you lose your regular principal and interest, but you could also lose all of that extra money that you paid down the equity. And guess what? If you don't have a job or if you're disabled, you can't refinance. You can't get that equity out. You can't go back to a 30-year loan. You could have a ton of equity built up in your house, but if you can't access it, it doesn't matter. Your house and all of the equity that you've overpaid on can end up going back to the bank. So overpaying your mortgage, paying down the balance faster, can end up putting you at risk and can end up causing you to lose money, a lot of money, and lose your house. Again, we're looking at kind of a worst case scenario, but people don't necessarily think about things like that, right? Because when you build up equity in your house, it's not always guaranteed that you can access it. That money can become dead equity. And in a situation like that, the banks love it, because they end up taking back your house and all of that equity right along with it. So again, just to kind of wrap up this video, I definitely do think, given the current climate of extremely low interest rates, I mean, if you could borrow $300,000, $400,000 at 2.5%, 3% interest, and then pay them back long time down the road with devalued dollars while you build your liquidity, while you build your emergency savings and your opportunity savings, and you can properly invest, to me, it's no brainer. But again, like I said, this isn't necessarily specific personalized financial advice. This is education. It's to get you to think. It's to get you to second guess some of these narratives that's been created by the financial matrix and by the banking industry. Paying off your mortgage early, it's this sacred cow that everybody thinks is just the truth. But when you really stop and think about it, it doesn't always necessarily make sense. There are better ways to do it. In fact, I know there are a lot of people out there who build their equity within a whole life policy. And when that equity in their whole life policy, when that becomes more than their mortgage, they borrow against their whole life policy and pay off their mortgage. And then they can pay their whole life policy back because the repayments on that are much, much more flexible and at lower interest rates sometimes. So that's an alternative. So anyways, if you have any questions about where you might be, I know one of my clients commented saying, hey, I was just talking about this with someone yesterday. I need to talk with you. Feel free to contact me, send me a message, shoot me an email, whatever the case might be. I would be happy to help and then put you in contact with a mortgage professional if we decide there may be something that you should do differently. So anyways, that's going to wrap up this week's rant. Go to my YouTube channel, by the way. I post all these talks on YouTube. It is Sneller Financial over on YouTube. Follow me there and click the notification bell. That way you get a notice anytime I upload new content. And I also have an email newsletter that goes out every week with blogs, videos, writings on different topics. Again, it's just stuff, just ways for me to stay in contact with people and communicate with you and just provide financial education. So if you want to be on my email newsletter, just send me a direct message here on social, just letting me know that and give me your email address. So that's pretty much all I wanted to cover here tonight. So that is my rant. And as always, thanks for listening.